Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, welcome to Wednesday, and thank you for joining Money Talk on the 6th of March. I have an update for you of the day's top business news coming up. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China set a growth target of around 5% for 2024, according to the government's work report released Tuesday. Premier Li Qiang said it's not easy for us to realise these targets. We need policy support and joint efforts from all fronts. The central government announced no major changes to monetary or fiscal policy. The government kept the budget deficit unchanged at 3% of GDP, entailing a tightening bias as the budget deficit was adjusted to 3.8% in the middle of 2023. The target for local government special purpose bonds was set at 3.9 trillion yuan. That's around 3% of GDP, and from 3.8 trillion yuan last year. However, the government did announce an extraordinary 1 trillion yuan in ultra-long special government bonds. That represents about 0.8% of GDP, in order to bail out stalled real estate projects and expand manufacturing capacity in what are described as new productive forces. Indonesia's presumed next president, Prabowo Subianto, said economic growth can accelerate to 8% within 5 years. And he vowed to maintain fiscal discipline when he takes the helm of Southeast Asia's largest economy. Speaking at an investment forum, he said that while the state could continue to regulate and maintain decision-making in strategic areas in Southeast Asia's economy, the private sector should be allowed to thrive and take the leading role. Sales of Apple's iPhone plunged in China in the first 6 weeks of 2024, according to a Counterpoint research report. The analyst firm said in a note on Tuesday that iPhone sales plunged 24% in the period as Apple faced stiff competition from local smartphone firms like Huawei, Oppo, Vivo and Xiaomi. Counterpoint's report said Apple's share of the Chinese smartphone market dropped to 15.7%, putting it in fourth place, compared with second place in the year-ago period when it had a 19% market share. Huawei rose to second place as its market share expanded to 16.5% from 9.4% a year earlier. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Andrew Sullivan, founder of Asian Market Sense. And with a view from Japan is Nick Smith, Japan strategist at CLSA. If you want to get in touch with any questions or comments, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed lower for a second session on Tuesday, pulled down by steep declines for major technology stocks, including 6 of the so-called Magnificent Seven. Wall Street's benchmark S&P 500 was down 1% at 5,079. The tech-heavy Nasdaq Composite slipped 1.7% to 15,940. The Dow lost 405 points, or 1%, to 38,585. Two of the largest contributions to the index declines came from Apple and Tesla. Apple slipped almost 3% on the back of that report from Counterpoint Research that found iPhone sales plunged in China in the first 6 weeks of the year. Shares of Tesla slid 3.9% on news of declining sales in China. Tesla's China-made vehicle sales of 60,400 vehicles were down 19% year-on-year in February, according to the China Passenger Car Association. Treasuries rallied after data showed growth in the US services sector cooled more than expected in February. The yield on the benchmark 10-year note was down 8 basis points at 4.14%, and the US dollar index depreciated 0.1% to 103.75 on Tuesday, the lowest level in about a month. The dollar was down 0.4% against the Japanese yen at 149.93. The offshore yuan was subdued around 7.21 renminbi per dollar. Spot gold prices have surged to a record high. The yellow metal rose for a fifth straight day to hit $2,141 per ounce, beating the previous record at $2,135, before retreating to end the day at $2,129 an ounce. Oil closed lower in choppy trading. It settled down 0.9% at $82.04 a barrel. And Bitcoin briefly hit a new all-time high for the first time in more than 2 years, with the world's largest cryptocurrency trading at $69,202 on Tuesday. That was before it almost immediately retreated back to around $62,000 on profit-taking. Hong Kong stocks sank as investors were disappointed in Premier Li Chang's work report at the MPC, which contained no major structural reforms and left little room for rate cuts and an implied tightening of fiscal policy. Hong Kong's Financial Secretary Paul Chan said that China's GDP target of around 5% for 2024 was possible, but it wouldn't be easy to achieve in the face of slowing global growth and persistent headwinds at home. Hong Kong's Hang Seng Index led losses in Asia, down 433 points, that's 2.6%, to a two-week low of 16,163. The Hang Seng Tech Index tumbled 4.3%. Tech shares were hurt by a report from Bloomberg News that Advanced Micro Devices would need to obtain a US government license to sell its AI processors to Chinese customers. Mainland Chinese equities were propped up with support from state fund buying. The CSI 300 index ended 0.7% firmer at 3,566. That's its highest since late November. And the Hang Seng projected to open about 28 points higher this morning when trading gets going, starting the day at around about 16,190 according to futures markets. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our regular Wednesday morning commentator, capital preservation specialist at Financial Shield, Enzio von Pfeil. Morning, Enzio.
Morning, Peter.
And also with us is Andrew Sullivan, the founder of Asian Market Sense. Morning to you, Andrew.
Good morning.
So let's start with the work report. China sets a growth target of around 5% for 2024, according to the government work reports released yesterday. The targets for GDP and other economic indicators were published as part of the opening of the National People's Congress annual meeting. Premier Li Chang said the foundation for the continuous recovery and improvement of our country's economy is still not solid, with insufficient demand, overcapacity in some areas, weak societal expectations, and many lingering risks. And he said it's not easy for us to realise these targets. We need policy support and joint efforts from all fronts. So, Enzio, what do you make of this? Higher than what most economists are expecting is a realistic growth target for 2024. I think the IMF is talking about around about 4.5% for growth. So, what do you make of this?
Well, I make little of both. The IMF, as we know, is kind of it tells you the time by looking at somebody else's watch, and the government of China. I think the mindset is a very different one. I think the mindset in China, rightly or wrongly, has moved away from the obsession with growth and profits to that of power. We can get into that later on, but so when they say 5% GDP, it's a very normative figure because GDP is based on a survey of capital depreciation stocks, of the capital depreciation of the national capital stock. And that is a bit of a mouthful to sort of digest. So the whole concept is erroneous. But in the case of China, it's also irrelevant. And that's really my key point, that Mr. Xi seems to think, rightly or wrongly, this is his prerogative, he's after all the leader, that he wants to have power, not growth at this stage. And that's why he's also not emphasizing stimuli as we in the West, with our profits investment mindset, would.
So, Andrew, let me get your thoughts, and then we'll delve into this a little bit more. Let's first of all talk about the growth target, 5%, around 5%, the same as last year. But how on earth are they going to do it? We didn't see anything in this plan, really, did we, that suggests how that's going to be achieved?
Well, I think that's it. And I think that was a large part of the disappointment with the whole report, was the fact that there was nothing special in it. These are the same sort of numbers that we saw last year. The difference is, as you point out, is the fact that last year they were recovering from COVID and the foreign investors were keen to get involved. That's not going to be the case this year. And as you say, without any clear way that they're going to restore consumer confidence and certainly, address the crisis in the property sector, then I think achieving that around 5% is going to be nigh on impossible.
Yeah.
And in particular, when they say that their inflation target is 3%, that basically means, I mean, I'm not an economist, but I am a mathematician, so I can work out that means nominal growth before inflation is 8%. They didn't achieve anything like that sort of growth last year.
Well, no, and you've still really got them seeing, deflation. And it was interesting yesterday that they're going to try and control, the pig herds, because that has a big implication for their CPI. But regulating pig herds as a way of driving your economy, I don't think is a particularly fruitful endeavour, to be honest.
This comes back to your point, Enzio, that the government really wants to control everything, even down to the size of the pig herds.
I think so. I think it's about power with Mr. Xi. And again, I'm not judging him. I'm just putting out the fact as he wants it seen, that he wants a very advanced manufacturing superpower to emerge. So forget growth and short-term stimuli. I want this superpower to emerge, and I want my state party capitalism to reign supreme. On top of which, again, with inflation, it's yet another survey-based piece of information based on a survey of China's, you got it, 53 million companies. I mean, just imagine doing a survey of 53 million companies to derive inflation data.
But in order to achieve his goals and have economic growth in certain preferred sectors, these productive areas that he's talking about, he needs short-term economic growth as well, doesn't he? Otherwise, there's just not going to be the time for those areas to develop, and also to offset the large declines that we're seeing in the property sector. So how does he propose to achieve that?
Again, my only silly response is that he thinks he can do this single-handedly on his own by a much stronger party control. I'm not agreeing with that. I'm just saying that's his mindset. I don't see myself a lot of hope for that, and that's why I'm telling investors just stay out of China. Don't even buy on the blip and all this cyclical stuff, because we're dealing with a very, 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 very sharp-toothed trend, the jaws of a trend, which is going to head the Chinese economy down. It's got to, because of this rejection of short-term stimuli.
So, Andrew, is this is basically then a target without a plan, isn't it? We've got the targets, the growth targets, but then nothing behind it in terms of either structural reforms. There was really nothing in terms of boosting consumer spending, nothing in terms of stimulus at all. So it sort of still begs the question, doesn't it? How is this going to happen?
Yes, I think that's quite right. And as I said, I don't think they really do have a plan. And I think that the other big issue that we have here is these targets, very similar to last year, really do beg the question of whether the top echelons of the leadership are really getting the truth about what's happening to the economy at the ground level. We've seen this increasing trend of going back to the cadres telling their bosses what the bosses want to hear rather than the facts on the ground. And I think that's going to be a big concern. And for investors, I think we saw that yesterday very much in the fact that, they were looking for those sort of details about how this was going to occur. And they're very disappointed that, again, we're getting lip service without any detail, as you say. The only point I would make is that I think probably I disagree slightly with Enzio there. I think this does make China very much a trading opportunity where you go in, come out quite quickly as these anomalies turn up. But that's not good for the long-term economy in China, and it's not going to be good for long-term investment either. But it does make it much more of a trader's market.
Point taken.
And
I just want to add, sorry, if I could just add one point, that paying lip service, well, I hate to disappoint all of us, but there will be no lip service. Mr. Xi in yesterday's South China was actually on the front page saying that he didn't want any more press conferences. So there is no lip service. It's what I call oil and water, which we see so much also in our Western democracies, of the government being the bubble of oil and then the water being the rest of us paysans, and there never shall the two meet.
I think I meant lip service very much in the fact that they're saying that they're going to do quicker legislation for the private sector. We've heard these words before, and we've seen again no detail and no implementation, and increasingly, therefore, investors, certainly long-term investors, they wait on the sidelines to actually see enactments, not statements.
Yeah, good point. Yeah.
Do you think maybe, you were saying, Andrew, that perhaps they're not getting the truth about the situation, or maybe is the other alternative to this is they are getting the truth, but they just don't understand the seriousness of the situation that the economy's in. Wages are falling, the country's in deflation, but they maybe just don't get that, this does need some pretty urgent measures. They have got the tools to do it, but they just don't seem to want to do it.
Well, I think you're right to an extent, and I think this goes back to what we've seen over the recent years where, party policy over economics is given the lead, and there's nothing that's changed here. They're not worried about the economy. They're not going to go bust overnight. It's just not very good for the long-term future of most of the population. But they will, as Enzio was saying earlier, they will have total control over all parts of society, which is what the Communist Party wants.
Another figure, Enzio, that was in the report that sort of is a bit of a struggle to understand, the inflation target. China set a goal of 3% for the consumer price index. It's done that every year, hasn't it, in the past 10 years, apart from 2020 when we had COVID. But the consumer price index rose by 0.2% on average last year. So how does it get from 0.2% to 3%? And how do you get consumers spending, which is presumably what it's going to need to do? There's going to need to be a boost to domestic consumption to pull the economy out of deflation. Did you see anything in the report that suggests how that might be done?
No, quite the opposite. There was as Andrew was saying, there was a lot of talk about also hopes for 12 million new jobs, but no action plan being created. So it kind of beats me, though. It's a little bit like our government here. We want to be the international financial center, but we're not going to speak English. But we will be international. In other words, the emperor is wearing clothes, even if he is naked. And so it does. Just for investors, Andrew's trading point totally notwithstanding, as we've all agreed, it's not a long-term store that you would put your pension money into.
Well, what do you make of this inflation target, Andrew? That's again begs a lot of questions, doesn't it, about how do you get from a consumer price index of 0.2% up to 3% without somehow consumers spending more and there being a big boost to consumption?
Well, I think that's the big problem, and as we're very much aware, the Chinese consumer, if they feel confident, they'll spend money, but if they don't, they have that propensity to save money. And I think the biggest concern for most consumers at the moment is the property sector, be it whether they are homeowners themselves, whether or not they have lent money to these wealth management schemes that have gone to be lent to property developers. All of it is just stopping people from spending. And until the government really does address that issue, and I think a lot of that issue is very much with the wealth managers who promised these high returns, also promised that they weren't going to lend it to property developers, and then ended up lending it to property developers. So I think it goes further than just policy. I think the big risk here is the fact that a lot of the early people that got rich, they bought property when it was being sort of privatized by the government. Even those people who have been big supporters of the government over the last 30 years are finding that a lot of their wealth is now disappearing because of the property crisis and situation. So, just as we saw them doing a U-turn on COVID as public resentment grew, I think you're going to see public resentment grow over these wealth management products and the property sector that will force the government to do something.
Enzio, who do you think is taking these decisions? It doesn't seem to be the cabinet anymore, does it? The state council.
No, it's certainly Xi Jinping. I think that he is made very public that he is the boss And The Economist ran quite a good article 2 weeks ago about his control. James King and the FT ran something similar a couple of weeks ago. So it's very much you take my way or the highway, I'm afraid. That's how I'm reading it.
And presumably that fits in with the cancellation of the Premier's press conference, which has been a tradition here, hasn't it? I mean, Li Keqiang used that to try and at least give some semblance that he was in charge of economic policy. Li Keqiang's predecessor.
Yeah.
Did use those press conferences to at least talk a bit more about economic policy, which is traditionally part of his area. But it seems that the State Council, the cabinet, isn't really in control anymore. It's just there to do as it's told.
I think so. I mean, that's certainly how, maybe mistakenly, but that's how I'm reading it. That he really is getting, Mr. Xi is getting his leverage through the party, hence the party state capitalism that we've been rattling on since January, and whereby actually if the party cell has a 1% stake in a private company, a 1% stake, it can tell the company what to do. And that's, of course, going to come from on high because the party is much more easily controllable than the government itself. It's just a much smaller entity with a huge leverage, with huge power leverage.
So, Andrew, what happens next if we don't see the economic growth that they're talking about, for around sort of 5%? What's left on the table to be done?
Well, I think they have a very difficult outlook here. I mean, they keep making these statements. I think half the time they are, putting out these statements to show that it wasn't their fault and it wasn't their problem, that it was something else. And I think they, constantly have to look for scapegoats. I suspect that in the property sector, part of it will be showing that there was fraud or mismanagement by these companies, not that the basic land program of local government being financed by land Ponzi schemes being an issue. It was mismanagement at the company level, and that's increasingly really, if you think about it, almost what we saw under Mao in the final days there. It was always looking for scapegoats and somebody else's problems, or outright lying, and just having complete control over the media. If you don't have a policy, you haven't really got any other alternative.
Yeah.
Enzio, there wasn't much sign of stimulus, really, was there? We saw the target for these local government special purpose bonds about the same as last year. Well, 3.9 trillion yuan. It was 3.8 last year, although we did get this announcement about these exceptional sort of ultra-long special government bonds, which Beijing tends to roll out at times of emergencies like the Asian financial crisis or the global financial crisis. What sort of difference are these going to make?
Well, they're cyclical band-aids on a structural problem. And it can't, as an economist, just as a professional economist, it can't work. You can't keep on sort of plugging a leaky barrel by taking one hole at a time and sticking some bubble gum in it. It just doesn't work.
I mean, these are sort of being described as being used to expand manufacturing capacity in new productive forces, although that rings a bell because that's exactly what they used to describe investment in the property sector as at one stage, didn't it? But that didn't work out too well. So how do we make sure that this investment, if it's going to go into new manufacturing capacity, is going to be productive manufacturing capacity?
It can't because excuse me for cutting you off, Peter. Because it's one man, Xi Jinping, saying, I know what's best for the economy. I will direct the manufacturing sector via my party cells in each private company to do what I say. And I'm sure because I'm tainted very much by von Hayek, let me blame this whole free market stuff that the market knows best. I'm afraid I stick with that. That's how I was trained. So I'm just trying to offer to our listeners that their mindset is very different. That's why we're not reading so much about the need for stimuli, because they see themselves as having a structural power game, not a cyclical growth game.
And can it work, this, expanding into these new productive forces, as they're called, which we presume means things like technological innovations like artificial intelligence, biotech, and so on?
I think certainly from a macroeconomics view, yes. I mean, the Chinese are pretty bright people, so they will figure out a lot of things. You said something about Apple shares having dropped a lot because Apple sales have gone down because a lot of local iPhone manufacturers in China are doing very well. So there is some of that muscle there, but it all depends on how much Mr. Xi wants to muscle in on that and control the direction of the private companies. And that's where I get back to this 1% rule in this marvelous book on state capitalism, party state capitalism, that even if the party still has 1%, it can tell the company what to do. This is interference that I'm finding disturbing from an investment perspective. That's not Mr. Xi's perspective, though.
Andrew, what are your thoughts? This investment in new productive capacities, new productive areas, can it work?
Well, I think it's lip service, isn't it? Because the reality is the restraints that the West is putting on tech exports to China just means it's not going to happen. We've seen AMD overnight. It had come up with a new chip that it thought met the restrictions required for supplying to China, and we were told no, it's still too powerful. So, it's going to take them a long time. And it's worth noting that, they're committing something like, I think they said 58 billion to tech, research, et cetera. Now, just put that in context. I mean, TSMC spends 5.5 billion on its R&D every year. So 58 billion over the whole country, in a country that's known to have problems with a lot of money disappearing and ending back up in property or other ventures, it doesn't seem to me like it's going to go a long way, especially when you're going to be restricted by foreign powers restricting the equipment that you need in order to do that.
So what does this mean for investors and the markets? If it's going to be, from what you're saying, it's going to be hard for China to achieve this 5% growth. We're not seeing really a huge increase in policy support, no new fiscal sort of measures, no restructuring sort of plans. Where does this leave Chinese equities?
Well, I think the first thing is probably very good for Japan.
Yes, exactly. Well put. Yeah.
People will reallocate that money to markets that are, as we said earlier, where you've got certainty about policy, where you've got openness about data, and where you can put your money in and get it out quickly.
Enzio?
Yeah, I totally agree. I just think that, again, Andrew's extremely valuable point about the trading opportunities, the very short-term trading opportunities, more designed for hedge funds, I think, that the outlook for the Chinese and thus the Hong Kong stock markets per se is pretty bleak under this guise of central control and father knows best. That's why I think it does open the opportunities for Japan, where the economic time may be improving a little bit, and for other parts of the world where the economic time may be improving. And of course, let's not forget that old stalwart, indefatigable U.S. economy, which keeps on sort of stonking ahead despite all of us silly economists with our predictions about slowing growth and all that.
Have we got to revise these earnings estimates now in light of what we've seen at the MPC?
I think a lot of people already have done, to be honest. But I think on Enzio's point there, I think what it does mean is that we do look at the risk of China having this sort of 5 to 10 year having to work its way out of the hole, just as we saw in Japan.
Exactly.
And I think the people that have traded Japan over the last 5-10 years, then China becomes their best trading venue.
How interesting.
Well, would you look at least at Hong Kong? Because it's sort of like less manipulated, isn't it, by the Chinese authorities, left more to its own sort of devices. Would Hong Kong be a reasonable way into some exposure to China?
Well, I think you look at the trading volumes that we've been seeing over the last few months, and you basically get the impression that, some days we've been trading as low as 60, 70 billion a day, where we used to be trading twice that in a day. I think the reality is that allocations just aren't going to China, and that reduces the necessity to trade Hong Kong. And if you are going to trade Hong Kong, then again, the hedge funds and the more active guys will be into trading individual stocks. But if you're a long-term mutual fund, you might just as well trade the ETFs, which give you the broad exposure that you want to China without having to go into too much detail.
And presumably the authorities are going to be there stepping in, buying ETFs themselves, aren't they, to try and support the market. We're going to see more days like we saw yesterday where maybe Hong Kong stocks decline, but we see this buying on the mainland stocks, which holds up the markets.
Yes, but I mean, again, it'd be interesting to see how long. I mean, they were talking about a stabilization fund, but I mean, they've been spending. Team China has been spending so much money in the last few months that it's difficult to be able to see them being able to actually have enough cash left to actually put together for a stabilization fund, especially as the government's going to be restricted in actually how much capital it has, to continue to support a market that it believes or doesn't believe in.
But presumably they want to get rid of anything in the market that's going to cause volatility, which is why they've been clamping down on things like these quant funds, because they see them as a source of what they regard as being dangerous volatility. We're going to see more of that.
Yes, I mean that's another reason for people not investing in, or mutual funds not investing in the market, because they know it's not a free market. If you're prepared to clamp down on hedge funds today, on quant, what are you going to clamp down on tomorrow? And of course, a lot of these mutual funds. The one thing, mutual fund managers, to a large extent, don't mind whether the market goes up or down. What they do mind about is if their money gets stuck somewhere. If a stock gets suspended or a market gets suspended and they can't get their money out, that's their investors' money and it's locked in. And China there's an increasing risk of that, which I think means for a lot of funds that they will either have to warn their investors that there is a real threat of that, or they will just come out of the market and go to another emerging market. And there are plenty out there for them to look at. It's
going to be very hard, isn't it, for them to explain this to their investors? It's going to be easier for them to just pull out of the market altogether.
Well, yeah, I think that's what they're doing. They're explaining to people at the presentations that these are the risks of going into China now. For the last 15 years, we'd seen and hoped that China was going to be opening up and becoming more westernized and becoming freer. And that happened for probably the first 5-10 years. But the last 5 years, we've seen a reversal of most of those policies. And hence, the mutual funds, they'll still tell you that there are good opportunities there. And there are good stocks still in China, but they're becoming harder and harder to trade and to invest in.
Enzio, what does this mean for the currency, the yuan?
I don't think a whole lot. I think as long as they keep their capital controls going and they tighten them up with the increased digitalization of currencies, I think that you'll find you can control them more and more, because you can still trace the flows much more than through cash. So I think it's probably more of a downward trend on the renminbi. The mainland government will clap its hands in glee that this means better exports. I myself, based on years of research, don't quite buy this weaker currency begets export story anymore, especially the more industrialized you get. But so there will be some imported inflation that maybe back to that 3% comes through that route, through a weaker currency. But certainly I can't see any reasons for a stronger renminbi other than if they just tighten up the capital controls even more than they have already.
And presumably there's very little room for easing monetary policy until the Fed does something itself because of this wide rate differential between China and the US.
Yes. But again, that's the cyclical band-aid stuck onto a structural problem, because as long as China wants power and not profits, as long as Mr. Xi wants power and not profits, I think that any stimuli is just going to be like sticking a piece of bubble gum into a leaky barrel.
Andrew, your thoughts on the currency, on the yuan and the room that they have for easing monetary policy?
Yeah, I think I agree with Enzio there. I think there's not a lot that they can really do to make it look attractive, certainly. And I think increasingly we are seeing rich Chinese trying to get their money further and further offshore. It used to come to Hong Kong, but then we saw that they could sequester your assets in Hong Kong, so it's going to Singapore, and then from Singapore it's going further and further afield. And I think this is another problem. You're getting a drain not only of the currency, but of the smart people that have generated the profits that historically have boomed for China in the last 15, 20 years. Those people are looking at different venues in which to set up their entrepreneurial ventures, and that's another problem for China going forward, because it really does need those people to create businesses, to create those jobs that are really going to try and get China out of the hole it's currently in.
Enzio, final thoughts from you?
Yeah, well, I agree. And that's what Andrew was saying was, for instance, the friendshoring going on in Mexico or into Southeast Asia, where a friend of mine pointed out that China's exports to Southeast Asia have now eclipsed those of exports to the U.S. because of all of these sanctions that the Americans keep on imposing, perhaps futilely. So the Chinese entrepreneurs are not asleep at the wheel. They know that their money is to be made elsewhere, just like the fund manager knows that their money is to be made elsewhere. It's just not going to be happening in China, nor indeed in that water ski off the back of the Chinese speedboat, Hong Kong.
Okay, well, thank you very much for your thoughts on all of that this morning. You heard there Enzio von Pfeil, who is Capital Preservation Specialist at Financial Shield, Andrew Sullivan, who is the founder of Asian Market Sense.
Peter Lewis's Money Talk.
I'm joined now by Nick Smith, who is Japan strategist at CLSA in Tokyo. Morning, Nick.
Good morning to you.
So Japan at last, the Nikkei 225 and the Topics reached new all-time highs. We last saw them back in December 1989. How significant is this?
I think for some people it feels like a curse has been broken. I mean, obviously in 1989, Japan was in probably the biggest bubble in human history, and so when it collapsed, the fall in asset prices was 4 times as large as 1929. Not sure why the Americans make such a fuss about 1929, but Japan's was a real bubble, and it caused a lot of problems. So it is getting out of its problems. I think one of the biggest problems was deflation. A lot of people used to ask, what's so bad about prices going down? That's a good thing. We consumers like it, but obviously it crushes corporate profitability, as well as making debts get bigger and bigger. And so getting out of that was a major part of it. But overall, this move towards pressuring companies to up their game is also working very well. Return on equity in Japan is about the same as Europe, but if it had been, its peak was in 2006, profit margins have improved. But if the balance sheet were the same shape as it was in 2006, then the return on equity would be twice as much as it is. So a very nice 18%. And so to an extent, this is a problem that they can solve before breakfast. Just deal with those balance sheets.
This used to be called the iron coffin lid, didn't it? That level that it reached back in 1989, because it was so hard to overcome. So there must be a sense of relief that finally the markets have got past that and can now look forward.
Well, I think so. I mean, I certainly hear a lot of people saying, but the US has been a much better market over that period, and therefore you should stay with the US. And I go, no, that doesn't make Japan the US a buy; it makes it a bought. There's a discount sale at the local supermarket. What's not to like? So I think there is a lot more potential in Japan. If you look at forward EPS, they're stumbling in Europe. They're stumbling in China. The US is on stretched valuations. It makes a pretty good argument for investing in Japan.
So I suppose, I mean, if you look back to 1989, when the Nikkei 225 was last at the record high, in the world's 20 biggest biggest companies by market capitalization. Back then, 15 of them were Japanese companies. I think right now, I don't think any of them are in the top 20, are they? So presumably this means, does it, that then maybe there's quite a way to go yet? Could we get back to maybe seeing some of these Japanese companies, particularly given all the corporate reforms, among some of the biggest in the world?
1989 was a lot of fun, but the result of it was a lot of years of hard and bitter agony. So, in a way, we don't want to go back to that, but I do think there's plenty of upside in profitability and upside in share prices from here.
So, what do you do if you've missed out? And I know some people who have missed out and are bemoaning themselves for it. You know, what do they do now? Do they say, you know, sorry, bad luck, you've missed out, it's too late now? Or is it, can you still get into this market in some way? What do you do if you haven't participated and you want to?
Well, obviously, the people who've not made the money are now saying the easy money has been made. There is no such thing as easy money, and it's always the people that didn't make it that say that. I think there are still plenty of places to invest in Japan. I mean, I think over the next couple of months we'll have a pickup in financial stocks, and then it's probably time to push them out of portfolios. I think overall improvements in profitability. I would have thought that the auto sector still got further to go. People had written them off and said, "Oh, the whole world's going to go electric vehicle," and then Toyota, for example, who stuck with its hybrid strategy, is looking pretty smart.
And do you go with the global sectors that are really booming around the world at the moment, those tech companies that are, you know, benefiting from AI and the likes, and, you know, maybe the push into electric vehicles? Or do you look elsewhere in Japan for sort of value?
We are talking about a market where 65% of Topix companies have 2 analysts or fewer, which means that unless you're a fluent Japanese speaker and are on the ground in Japan, it's difficult to be terribly knowledgeable about some of the smaller companies. So coverage drops off very fast. I would have thought as money continues to come into Japan to close people's underweights in the market, that the money will continue to go into big companies first. So it's the bigger companies that are outperforming at the moment. I mean, ultimately you'll get to the smaller companies, and people are just going to have to do the homework, but that'll probably require hiring first.
So that presumably is where you could find some of the hidden gems, because everyone knows the SoftBanks and the Toyotas of the world, but presumably in some of these smaller companies there are young, up-and-coming companies, there are growth companies among them, and as you say, they may not be so well known or so well covered, but that's the opportunity maybe to find some hidden gems.
I think within small cap Japan, outside the top 500 companies, I think you'll find that they're largely companies that are small because they used to be large. Rather than growth companies. And I was really interested to find, when I looked at average and median growth rates over 10 years, that the big companies had the best growth and the small companies had the smallest growth, which is a little counterintuitive, but it is what it is. And so if you are picking around smaller companies, what you're going to find is you may find some gems, but you may well find that Schumpeter has been plugged back in again, and that companies that are not doing well may end up bankrupt. You couldn't afford it, and the government was trying to prop everybody up for many of the tough years, and now they feel actually we've got a labour shortage and we need to let some of these companies die so that we can unclog the arteries of the economy.
So one of the other things that we should be looking out for is obviously interest rates. We're hoping that the Fed is eventually going to cut rates, although the markets seem to be pricing in less and less rate cuts. But presumably once these come, do you put together a shopping list for Japan that's going to benefit from that?
Certainly, I think over the next few months, that's going to be the issue. It's complicated by the fact that Japan's about to go up and the US is about to go down. So you've got to certainly think about the yen dollar rate and all of that. I've done a lot of work showing that historically, before the Bank of Japan locked rates at zero, that strong yen used to go with strong corporate profits and not the reverse. Everyone thinks it's the reverse, but showing that they've offshored, and the damage from the yen is nowhere near as large as the benefits from a stronger global economy, and the two tend to go together. So I think that we're going to get the pain trade of share prices going up combined with a stronger yen, making Japan a pretty compelling case.
And the Bank of Japan, of course, we're waiting, aren't we, for them to make their move. Is that going to come soon?
Yeah, what I've been telling people is that you've got to look back at the speech of the deputy governor in December, where he's showing you that financial repression, so driving down of interest rates, has hurt households, it's hurt corporates, and it's hurt financial companies. And that's not what most people expected to see, but his data is pretty difficult to refute. So what it seems to show is, I'm really, really sorry about what the BOJ's done, but that was the previous administration. We're different. We're going to get it changed as soon as we can, which may well mean 19th of March is the moving date.
So we're making our shopping list for interest rates coming down. What if we're wrong, and what if the markets are wrong and interest rates don't come down this year? The Fed finds itself trapped in a hole whereby the data just doesn't allow it to cut interest rates, or maybe, as some people say, Larry Summers, one of them, saying interest rates may even have to go up, not actually come down. What does that do to Japan?
Well, it is a problem. The US is much more important for Japanese corporate profits than China is, and Japan is a fairly deeply cyclical stock market. So, if the Fed gets it wrong and fails to cut rates, and the US goes into recession, then Japan's got some problems. That's not what PMIs are saying. That's not what a lot of other leading indicators are suggesting. But I think that Japan's still got something of a recovery story from pressure on companies to improve their profitability. I mean, this is, of course, a problem that you hadn't been able to deal with before. So closing down non-core businesses, for example, was very difficult to do when Japan had excess employees, and the law made it very difficult to fire people. Now it's got a severe labour shortage, and that allows M&A to pick up. It allows closing down of non-core businesses. There's a lot that companies can do to improve their profitability at the moment.
Okay, Nick, always a pleasure to talk to you. Thank you very much indeed for that. You heard there Nick Smith, who is Japan strategist at CLSA in Tokyo.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Econosis Advisory, and Frederick Chu, Managing Director at Magnum Research. And with a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taipei. Have a good day.
Money Talk.